What if I told you that you could potentially double your money by simply following the lead of one of the greatest investors of all time? That's right. Today we're diving deep into the world of Warren Buffett and uncovering 3 stocks in his portfolio that you should consider adding to yours right now. We're talking about a global leader in electric vehicles shaking up the auto industry, a beverage giant with unmatched brand recognition, and a financial powerhouse making waves on Wall Street. These aren't just random companies, these are strategic holdings of Berkshire Hathaway, the conglomerate led by the Oracle of Omaha himself. If you only watch one video today, make sure you watch this one, all the way till the end. We're about to break down why these companies are poised for growth and how you can potentially profit from their success. Hit that like button, let's get 1,000 likes on this one, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Let's kick things off with BYD, ticker symbol BYDD.F on the OTC, a Chinese multinational conglomerate that's absolutely dominating the electric vehicle market. This company has been making waves not just in China, but globally. And when I say dominating, I mean dominating. They have a massive production capacity and an ever-expanding lineup of electric vehicles. They're not just building electric cars, they're also venturing into other forms of electric transportation. They're building electric buses, trucks, bicycles, you name it. Their range of products is truly impressive. Warren Buffett saw the potential in BYD early on, recognizing the company's innovative approach and long-term vision. And his investment company, Berkshire Hathaway, made a strategic move. First bought shares back in 2008. This was a time when electric vehicles were still a nascent industry. Talk about a long-term vision. And guess what? That investment has skyrocketed in value, proving Buffett's foresight. That investment has skyrocketed in value. It's a testament to the potential that BYD holds. But here's the thing. BYD's not just riding the wave of the EV boom, they're driving it. They're vertically integrated, which is a game changer, meaning they control almost every aspect of their production process, from the initial design to the final product, from battery technology to manufacturing. This level of control allows them to innovate rapidly and efficiently. This gives them a huge advantage in terms of cost and efficiency. They can streamline operations and reduce costs significantly. Think about it, Tesla, one of the biggest names in EVs, relies on other companies for things like batteries. This dependency can sometimes slow down innovation and increase costs. BYD, on the other hand, makes their own, ensuring they have complete control over quality and supply. And they're actually supplying batteries to other automakers. This not only diversifies their revenue streams, but also establishes them as a key player in the industry. That's like Apple making their own chips, and then selling them to Samsung. It's a brilliant strategy that sets them apart. This kind of vertical integration is rare and highly advantageous, and it's not just about cars. BYD is a major player in electric buses, especially in China, where the government is heavily investing in clean transportation. This has given BYD a significant boost in their home market. They're also expanding into other markets like Europe and North America. This global reach is crucial for their long-term success. But here's the kicker. BYD is still incredibly undervalued compared to its competitors. This presents a unique investment opportunity. The company currently boasts a market cap of $134.87 billion and an EPS of $13.85, all while trading at an incredibly low PE ratio of just 3.20. That's unusually cheap for a company posting such massive numbers. In 2024 alone, BYD generated a staggering $777.10 billion in revenue, with a net income of $40.25 billion. Despite these huge earnings, the stock is trading at just $44.33 per share, which is nearly 186% below its estimated fair value of $126.78. That kind of discount raises eyebrows. It suggests that the market might be severely underpricing the stock, potentially offering a major opportunity for value investors. With a dividend yield of 0.98%, it's not a major income play, but the low valuation could point to serious upside potential if sentiment or global conditions shift. Their price-to-earnings ratio is significantly lower than Tesla's, even though they're selling more EVs. This discrepancy is something investors should take note of. These numbers tell me there's still a huge opportunity for growth. The market hasn't fully recognized BYD's potential yet. This tells me there's still a huge opportunity for growth. If you're looking for a high-potential investment, BYD should be on your list. Now I know what you're thinking. Investing in Chinese companies can be risky. And you're right, there are always geopolitical factors to consider. However, the potential rewards can outweigh these risks. But, here's the thing, BYD is a global company. They have a presence in over 70 countries and regions. This diversification helps mitigate some of the risks associated with investing in a single market. They're not just reliant on the Chinese market. Their global footprint is a significant advantage. Plus, their commitment to innovation is undeniable. They're constantly pushing the boundaries of what's possible with electric vehicles and battery technology. This relentless pursuit of innovation keeps them ahead of the curve. They're even developing their own operating system for their cars, similar to what Tesla does. This adds another layer of differentiation and control over their product ecosystem. So if you're looking for a way to invest in the future of transportation, BYD is a company you need to have on your radar. They're a leader in a rapidly growing market. They have a strong track record of innovation, and they're backed by one of the greatest investors of all time. What's not to love? Now, let's talk about a company that needs no introduction: Coca-Cola, ticker symbol KO. This iconic brand has been a staple in households around the world for over a century. I mean, who hasn't enjoyed an ice-cold Coke on a hot day? It's one of those simple pleasures that transcends age, culture, and geography. But here's the thing, Coca-Cola is more than just a sugary drink. It's a symbol of refreshment and joy, a brand that has woven itself into the fabric of our daily lives. It's a global behemoth with a brand so powerful, it's recognized in every corner of the world. From bustling cities to remote villages, Coca-Cola is everywhere. We're talking about a company with a portfolio of over 200 brands, including Sprite, Fanta, Dasani, Minute Maid, and of course the iconic Coca-Cola. Each of these brands has its own loyal following and contributes to the company's massive market presence. They're selling billions of servings every single day, and their reach is unparalleled. Their bottling plants and delivery trucks are a testament to their logistical prowess. Now you might be thinking, Coca-Cola? Really? Isn't that a bit boring? After all, it's just a beverage company, right? And yeah, it's not exactly the sexiest stock out there. It's not going to make headlines with groundbreaking innovations or sky-high growth rates. It's not a high-growth tech company promising to revolutionize the world, but that's precisely what makes it so appealing to a certain type of investor. Coca-Cola is the definition of a safe and stable investment. It's the kind of stock you can count on to deliver consistent returns year after year. They've been around for over a century. They've weathered countless economic storms, and they're still standing strong. Their history is a testament to their resilience and adaptability. They're like that reliable friend who's always there for you no matter what. You know you can count on them, and that kind of reliability is invaluable in the world of investing. But here's the thing, even though Coca-Cola is a mature company, they're not just sitting back and collecting dividends. They're constantly innovating and looking for ways to stay relevant. They're constantly adapting to changing consumer preferences. Whether it's launching new products or tweaking existing ones, they're always looking for ways to meet the needs of their customers. They're expanding into healthier options like bottled water, teas, and sports drinks. This diversification helps them tap into new markets and appeal to health-conscious consumers. They're even experimenting with new flavors and products to keep things fresh. This willingness to innovate is a key reason why they've remained relevant for so long. And let's not forget about their incredible distribution network. Their ability to get products to consumers quickly and efficiently is a major competitive advantage. They've got this massive global infrastructure that allows them to get their products into the hands of consumers everywhere. From the biggest cities to the smallest towns, Coca-Cola is there. I mean, you can find a Coke pretty much anywhere on the planet. That's power. It's a testament to their unparalleled reach and influence. Now I know what you're thinking, what about the health concerns with sugary drinks? It's a valid point and one that the company takes very seriously, and you're right, that's definitely something to consider. But Coca-Cola is not ignoring these concerns. They're actively working to address them. But here's the thing, Coca-Cola is aware of these concerns, and they're actively working to address them. They're reducing the sugar content in their drinks, they're offering smaller portion sizes, and they're heavily promoting their healthier alternatives. This proactive approach is helping them stay ahead of the curve. They're also investing in marketing campaigns that promote active lifestyles and balanced diets. This not only helps improve their brand image, but also aligns them with the growing trend towards healthier living. With a market cap of $300.95 billion, Coca-Cola pulled in $47.06 billion in revenue last year and reported a net income of $10.63 billion. Its EPS of $2.47 and PE ratio of 28.31 suggest investors are willing to pay a premium for that consistency. And with a dividend yield of 2.81%, it's a favorite for long-term income investors looking for steady, reliable returns. While growth might be modest compared to high-flying tech or EV stocks, Coca-Cola remains a cornerstone of many portfolios, especially in times of economic uncertainty. So, if you're looking for a stock that can provide stability, dividends, and even some growth potential, Coca-Cola is a solid choice. It's a stock that offers a little bit of everything. They're a global powerhouse with an iconic brand, a diversified portfolio, and a management team that's committed to adapting to the times. Investing in Coca-Cola is like investing in a piece of history with the promise of a stable future. Now let's move on to a company that's a little more under the radar but has the potential to deliver some serious returns. Jefferies Financial, ticker symbol JEF. Now, unless you're deep in the world of finance, you might not have heard of Jefferies, but trust me, they're a big deal. We're talking about a global investment banking and financial services company with a history dating back to the 1960s. They're involved in everything from investment banking and capital markets to asset management and securities trading. They're like the Swiss Army knife of Wall Street. Now you might be thinking, investment banking? That sounds risky, especially after the 2008 financial crisis. And yeah, you're right, the financial sector can be volatile. But here's the thing, Jefferies is different. They're not your typical Wall Street behemoth that's too big to fail. They're more nimble, more entrepreneurial, and more focused on building long-term relationships with their clients. They're like the scrappy underdog that's always punching above its weight class. And guess what? Warren Buffett loves a good underdog story. Berkshire Hathaway has been a long-time investor in Jefferies, and they've been steadily increasing their stake in the company. That tells me they see something special in Jefferies. But here's the thing that really excites me about Jefferies. They're perfectly positioned to benefit from several key trends in the financial industry. First, there's the rise of private markets. More and more companies are choosing to stay private longer, and Jefferies has a strong track record of advising and financing these companies. Second, there's the increasing demand for alternative investments. Institutional investors are looking for ways to diversify their portfolios beyond traditional stocks and bonds, and Jefferies has a growing platform of alternative investment offerings. And third, there's the ongoing consolidation in the financial services industry. As smaller players struggle to compete, Jefferies is well positioned to acquire market share and expand its reach. Now, I'm not going to lie, Jefferies is not without its risks. The financial sector is inherently cyclical and their performance can be affected by factors beyond their control, like interest rates and economic growth. But here's the thing, I believe the potential rewards outweigh the risks. Jefferies is a well-run company with a strong management team, a diversified business model, and a compelling growth story. And with Warren Buffett's stamp of approval, I'm confident in their long-term prospects. With a market cap of $8.89 billion, the company generated $10.52 billion in revenue in 2024 and brought in $669.27 million in net income. Its EPS of $3.08 and PE ratio of 14.01 make it a reasonably priced option in the sector. What really stands out is the dividend yield of 3.25%, which is higher than both BYD and Coca-Cola. That's a healthy payout for shareholders, especially from a financial firm that isn't often front and center on Wall Street. Jefferies may not have the scale of bigger banks, but its performance and shareholder returns suggest it could be a hidden gem for those looking to diversify their exposure to finance. Jefferies has always been known for its innovative approach to financial services. They are constantly looking for new ways to serve their clients and stay ahead of the competition. Their adoption of cutting-edge financial technology has allowed them to streamline operations and offer more efficient solutions to their clients. Additionally, Jefferies has been expanding its global footprint, tapping into emerging markets and establishing a presence in key financial hubs around the world. Their commitment to diversity and inclusion has also set them apart, attracting top talent from various backgrounds and fostering a culture of innovation and collaboration. Jefferies' client-centric approach has resulted in numerous success stories, with many clients praising their personalized service and deep industry expertise. Looking ahead, Jefferies has a clear vision for long-term growth. Their strategic planning and forward-thinking approach ensure they are well prepared to navigate the ever-changing financial landscape. With a strong balance sheet and a focus on financial stability, Jefferies is well positioned to weather economic uncertainties and continue delivering value to their shareholders. In conclusion, Jefferies Financial is a powerhouse on Wall Street that deserves more recognition. Their unique blend of innovation, agility, and client focus makes them a standout player in the financial industry. So if you're looking for a company with strong growth potential and a proven track record, Jefferies Financial should definitely be on your radar. So there you have it. 3 Warren Buffett stocks that you should consider adding to your portfolio today. Each of these companies tells a different story. BYD with its undervalued growth potential, Coca-Cola with rock-solid stability, and Jefferies with its attractive dividends and under-the-radar value. Depending on your strategy, all 3 present unique opportunities in today's market. Remember, these are just a few of the many great companies that Berkshire Hathaway is invested in. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these Warren Buffett stocks are you most bullish on? Let me know in the comments below. Remember to like, share your thoughts in the comments, and subscribe to the YouTube channel for more awesome stock market content. See you in the next one.